Hey team, hope you're having a great Monday. Hey, there's a lot of news floating around out there surrounding the failure of Silicon Valley Bank and a couple others that have happened over the weekend. And I thought I'd just take a minute to touch on it. I hope you watched Barry's update on the MBS highway today. And I'm going to add a little to that, but I just want to start with if you don't have the MBS highway, maybe this will help you understand what has happened and why it's a good thing for us in a way. It's this. So banks, when they accept consumer deposits, they have all this cash. They don't keep piles of cash laying around. They take that cash and they reinvest as much as they possibly can. I think it's 90% they can reinvest, and they typically buy U.S. Treasuries. So they can buy U.S. Treasuries, and you buy that. You take $100,000 and you buy a Treasury, and 8 months ago you would get a return of 8%. Fast forward to today, you take $100,000 and you can buy one and get 5%. So a dramatic improvement. But they buy those bonds and they hold them because they have to hold asset value. They have to hold reserves to be able to pay their depositors back if their depositors decide to pull their money out. So there was a run on Silicon Valley where depositors were pulling their money out. And so Silicon Valley had to go, okay, I need my money. So they went to their bonds they had purchased, their treasuries they had purchased to sell them and reimburse their clients. Well, there's a rule for banks that they don't have to realize any reduction in the value of their bonds until they sell them. So there was this big loss in value that was sitting out in the ether, unrealized, because if you bought your bond and it yielded 2% 8 months ago, and now the new one is 5%, nobody wants to buy your 2% bond when they can just go buy the 5% one from the government. So the only way to sell that is to make it even. That means instead of dollar for dollar, you're probably selling that bond to somebody else for 60 cents, 65 cents on the dollar to make the yield comparable, the overall cost of the thing. And you have to realize that reduction in value, and that's what happened to Silicon Valley Bank. They had to liquidate tons of their bond holdings, created this massive loss, and just devalued the organization immediately. They became illiquid, and they got shut down. So scary stuff that can happen. And the reason it's happening is because of the super fast run up in rates that has been happening by our Fed pumping rates up. So I would imagine right now there's a whole lot of regional bank CEOs, or CFOs better yet, speed dialing the Fed to say, help, you need to stop raising rates so rapidly. It's not the only thing, but it's a big thing. And the Fed has to pay attention to the U.S. banking system, as they're now having to prop up these banks who said they're going to make those clients whole. That's incredibly expensive to make those clients whole. They have to take heed, and they're probably going to start having to loosen up policy. This could be a big turning point where the Fed sentiment changes a bit and we see rates come down in the future. But I think hopefully that's helpful. Hopefully it explains a little bit of what happened. If you want to go deeper on that, I'm here, be happy to talk. But clearly the market had a wonderful response to it. The mortgage market had a wonderful response to it today, and we'll probably see some follow through for the days to come. But keep your heads up out there. Keep going strong. You need to talk about this more, give me a call. I am around. Bye, everybody.